Hello traders and welcome back to the Forex Geek. Today's analysis focuses on a powerful chart pattern that signals significant market reversals. So we'll be talking about the bearish rectangle pattern. This formation has consistently preceded major price movements, offering traders clear entry and exit points with defined risk parameters. You will learn how to identify this pattern, understand its psychology, and most importantly, how to trade it effectively in any market condition. The bearish rectangle isn't just another pattern, it's a strategic tool that professional traders use to capture substantial moves in the forex market. So stay on to the end as we examine real chart examples and reveal the exact strategy to capitalize on this high probability setup. So whether you're trading major pairs or cross currencies, this pattern will enhance your technical analysis toolkit and help you spot profitable opportunities with greater precision. So let's get started. The bearish rectangle pattern emerges during established downtrends characterized by price movements that consolidates between two parallel horizontal lines. This pattern represents a temporary pause in the market's downward momentum where prices oscillate between clearly defined support and resistance levels. So to identify a valid bearish rectangle, you need to observe four critical components. First, verify that the pattern forms during a clear downtrend. Second, look for at least two distinct touches at both the upper and lower boundaries. Okay, here I have three touches, but if you see two, it's alright, you can use it. The third, ensure these boundaries run parallel to each other. And finally, confirm that the price action between these levels show consistent back and forth movement. So the psychology behind the pattern reveals institutional traders accumulating short positions, while retail traders often see this consolidation as a potential reversal reversal to the upside. Professional traders recognize it as a continuation pattern preparing for the next leg down. So the most crucial aspect of this pattern is its ability to provide clear price targets. The height of the rectangle measured from support to resistance typically equals the minimum price movement you can expect after the breakout occurs. So let's quickly look at our charts and spot some examples of the bearish rectangle pattern. We have one right here. So remember the characteristics. We should be in a clear downtrend, which is the first one, and you can see we are in a clear downtrend here. Second, we should look for at least two distinct touches at both the upper and lower boundaries. Here we have three. I have the 1, 2, have another one down, have the second here, have the third here, have the third here, and the breakout. Finally have the breakout and the continuation to the downside. So that is for this example. Let me look for another example. Okay, I have one here. So you can see this example is a clear example. We are just starting a bearish trend. Right here. So you can see price giving us this rectangular price action right here with the back and forth. We have clear downtrend, have this touch second before we had the breakout, a little pullback, and continuation to the downside. So this is the bearish rectangle chart pattern. Okay, so let's talk about how to trade using this chart pattern. The bearish rectangle pattern represents a systematic trading approach with clear entry points, stop losses, and profit targets. So your entry signals occurs when price breaks below the lower support line of the rectangle. So you should wait for a candlestick to close below this level, and this pattern separates successful traders from premature entries. So the optimal entry point comes after a retest of the broken support, which often acts as a new resistance. So it's not every time that price retests this level. If you are an aggressive trader, you could just enter as price breaks with momentum from that the lower boundary of the rectangle. But if you are a conservative trader, you should wait for a retest of that support turn resistance line before you take your short positions. So in this case, we have price breaking below the low of the rectangle with enough volume. You can see it's confirmed by our volume. We have increasing volume in the market, so we could just look to enter. If you're an aggressive trader, you could just look to enter a short position at the close below this level. So for your stop loss, you should position your stop loss above the rectangle's midpoint, and this placement protects your trade while giving the pattern enough room to develop. The distance between your entry and stop loss determines your position size. Never risk more than 1% of your trading capital on a single trade. So like I said, it should be above the midpoint of the rectangle. If you want to know the exact 50% of this rectangle, just use your Fibonacci, draw your line, just draw from the 50% of your Fibonacci, and you can have it right there. So that is the midpoint of this rectangle. So just stop losses should be above, just above the midpoint. And for your take profit levels, you should calculate your profit target by measuring the height of the rectangle and projecting this distance downward from the breakout point. So for example, if the rectangle is 100 pips tall, your minimum target should be 100 pips below the breakout level. But for me, I prefer to use fixed risk to reward ratio like the 1:2 or the 1:3 risk to reward ratio for my trades. Or you could also target significant support levels for your take profit targets. So this is it. We have this 1:2 trade. Let's look at our other example. So you can see this one, we had the retest of that line. This is it right here. We had the retest of this support line, support turn resistance line. So our entry will be here, and our stop loss, remember, should be at the 50%, a little above the 50% of our rectangle. So if you want to calculate that, just use the Fibonacci, and you can see this is the 50%. Oops, price almost got to the 50% level, but it didn't exactly hit it, so we did not get stopped out of this trade. Okay, so targeting 1:2 risk to reward ratio, you can see we hit our take profit here. And if you're looking to target significant support levels, this is one, and this would have been hit, take profit hit. If we targeted that level, you can also target this one right here, but price didn't exactly get to that area. So remember to monitor volume during the breakout. Higher than average volume confirms the pattern's validity and increases the probability of a successful trade. Lower volume during the rectangle formation, followed by a volume spike on the breakout, provides the strongest confirmation. Okay, let's look at the volume. I think I have okay, let's use this as an example. You can see the lower volume as the rectangle was forming. You can see right here, low volume. All the trading activity inside this bearish rectangle consisted of lower volume. So you can see here, as we had the breakout, we have increasing volume, signaling that yes, institutional traders are indeed entering this trade, and we should be looking for the push to the downside. So this can be used for confirmation of our trades before entry. So the bearish rectangle pattern stands as one of the most reliable technical formations in forex trading when properly identified and traded. By following the specific entry rules, respecting your stop losses, and maintaining proper position sizing, you can effectively capitalize on this powerful continuation pattern. Remember that successful trading comes from patience and discipline. Wait for clear confirmation before entering your position. So the chart examples we've covered today demonstrates how this pattern repeats across different currency pairs and time frames. If you found value in this technical analysis, support the channel by hitting the like button and subscribing. Don't forget to activate the notification bell to receive alerts about new trading strategies and market analysis. Until next time, trade with precision and always protect your capital. Thank you very much.